Hello and welcome to our Friday edition of CMS Forex News. I'm your market analyst, Nick Nassad. Today is February 27, 2009. We start today's broadcast with fundamental news from Japan. Industrial production fell another 10% in January, preliminary data showed. That follows a 9.8% drop in December and is a fresh record low for the index. Companies are reining in orders as exports plummet and domestic spending by both companies and consumers falters. Companies are working off their inventories and do not want to be caught with extra goods during a time of weak economic activity. For the first time in 6 months, the pace of contraction in the manufacturing sector did not accelerate, though the manufacturing PMI index at 31.6 showed marked weakness in the sector. Household spending in Japan dropped by 5.9% in January, which came close to the forecast figure. It is the biggest drop in spending in more than 2 years and follows a pullback of 4.6% in spending in December. Just like the industrial production data that came out today, the report reinforces the weak state of the Japanese economy. The unemployment rate fell to 4.1%, surprising forecasts. This seems to fly in the face of the data and news coming out of the economy, where companies are shedding payroll to control costs during a deep recession. The one reason behind the decrease was an increase in housewives taking part-time work in order to supplement declining household incomes. Japanese retail sales were down 2.4% on the year in January, which was a better than expected result and slightly better than the 2.7% decrease seen in December. Today's session saw a burst of risk aversion, which though in the last 2 weeks has not necessarily helped the yen, it did so today. The Aussie yen pair, for instance, began sliding late yesterday after reaching the 64.40 level. From that high, it proceeded to fall 300 pips to the 61.40 level. This was a 61.8% retracement of this week's rally in the pair, and the Aussie managed to recover about half of its losses in New York trading. The yen displayed similar price action against most of its rivals. In this look at the pound yen, we see an almost 450 pip move in favor of the yen, setting an intraday low near 136.70. The pair then recovered from that low to the 140 level as U.S. equity markets recovered from a fall in the morning and were set to close the day around their open. In fundamental news, the UK consumer confidence increased 2 points to negative 35. Consumers are feeling gloomy about the current situation, but measures for how the economy and consumers' personal finances will fare over the next 12 months did improve. In Germany, consumer inflation was higher than expected in February, as prices climbed 0.6% on the month and 1% compared to the same time last year. Rising prices for packaged holidays were the main culprit behind the rise in CPI. Expectations, though, are that price pressures will continue to ease in the first half of 2009, despite today's results. In the Eurozone, the unemployment rate rose to 8.2% for January, and December's rate was revised higher to 8.1%. Companies in the Eurozone are laying off workers as the economy's recession deepens. The Euro-Pound pair was lower today after a rally overnight stalled and reversed near the 0.8945 area. The pair fell to 0.8860, slightly below yesterday's low. The pound and UK equities were pressured overnight as the Lloyds Bank failed to clinch an asset insurance deal with the UK government. However, as stocks recovered on the other side of the Atlantic, the pound found renewed strength. In the US, fourth quarter GDP was revised lower in its second release to show a 6.2% annualized decline compared to the previously posted 3.8% decline. The result was worse than expected. Downward revisions in inventory growth, consumer spending, and exports were the main factors in the fall in the data. Inventories alone appeared to account for about half of the downward revision, as they shrank $19.9 billion instead of rising by $6.2 billion as the Commerce Department originally reported. In two other releases from the U.S., the Chicago PMI improved to 34.2 for February, and the UMich Consumer Sentiment saw its final version for February increase to 56.3, which was slightly higher than the preliminary release, though lower than the 61.2 seen in January. Consumers feel the recession will last throughout 2009 and are most concerned about the increase in unemployment. The euro-dollar pair fell overnight on increased risk aversion, touching the 1.26 area, but then rebounding to the 1.27 area in New York trading. After volatile trading to end last week and begin this week, the pair has gotten less volatile, though throughout the week the greenback did get stronger. The US dollar-Canadian dollar pair saw a strong rally today, rising above its recent downward sloping resistance level and reaching a new one-month high near 1.2730. The loonie was not able to regain its losses, like some of the other currencies we saw tumble overnight. Oil prices fell today, though they did see a rebound to the $44.50 a barrel level in late afternoon trading. Next week, there are 4 central banks deciding on interest rates, which should dominate the fundamental scene. The Reserve Bank of Australia, the Bank of Canada, the European Central Bank, and the Bank of England are all expected to cut rates. In addition to manufacturing and services data for February from the key countries, we will also get the non-farm payroll release on Friday from the U.S. And that wraps up this week in the Forex markets. Thank you for joining us here at CMSFX.com. From everyone here, we wish you a great weekend.